Welcome students. So, in the last lecture we were talking about the price elasticity of demand and continuing the process in the same way. Price elasticity of demand, when we were talking about, is that we all understand is that the impact of the price on the changes in the demand. So, we have to, when we are going to set up a new venture or a new organization or a new maybe business undertaking, we will have to be very careful that whatever the product or service we are going to come up with, that has to be priced in a way that is going to be maybe within the reach of the people, or people are going to like to pay that price. Or if you fix up the price which is really more than the existing products or the variables in the market, or maybe substitute products in the market, then it will be a big challenge to you and your product or your service. So, you have to be very careful that price has very important role to play on the demand of any product or the service. So, we have to keep the price within the say acceptable range of the maybe the customers, or maybe the future customers or the present customers or whatever it is. And if it is controlled, if it is kept within control, then I think you can expect that there will be a good demand in the market. So, always be careful that price is going to play a very important role, very critical role, and if you keep the price under control, means larger part of the battle you are going to win, because in a price sensitive economy like India, people weigh price in a big way. They want it that yes, the price of the product or the service should be within the range of payment, or maybe within the range of income. They want to make use of the product, they want to make use of the service, but if the price is beyond their reach or the reach of the masses, then it will be a problem. So, in this whole process, we have to keep the price within the range or the paying capacity of the people, and if we do that, if we are able to do that, we will be getting a good market, or we will be able to give a good stiff competition to the existing players in the market. We all understand that how Jio succeeded in the market. They always kept the price in their mind. Initially they gave the service free of cost for 6 months, and after that when they priced the service, that was certainly much lower as compared to the prices of the existing players of the mobile telephony, Airtel, Vodafone, Idea, or maybe BSNL. So, the quality of service was also good, that was provided at a very reasonable price. So, that gave impetus to Jio, and it became the second largest mobile service provider in the country in a short span of the maybe how many years, 8-9 years, and Jio is now a recognized name in the mobile telephony market. So, price is a very important consideration. Wherever you talk about any product or service has succeeded in the market, largely that has succeeded because of the price content or the price component. If you keep the price within the range of the people or within the control, you will find good buyers, good markets, and maybe in that case the existing products can go out of the market if they are not priced as per the price of the new product or the new service. So, it has a very good impact. Always be careful that you have to keep the price under control, and we all understand that if you want to keep the price of the product or service under control, you have to control the cost. So, look for the alternatives all the times. At the time of production or manufacturing of anything, when you produce anything, you have to look for the input cost, and you have to keep the input cost as low as possible. If you control the input cost, in that case it is going to be a win-win situation, because you are going to control the price ultimately, because cost is the basis of the price. So, price elasticity of demand is going to play a very important role, and you have to be very careful in controlling the price or delivering the goods or services at a price which is quite reasonable. So, it means when you see here, price elasticity of demand is useful tool in demand analysis. It is a very important tool in the demand analysis, and we have to be careful while pricing the product or the service when we are going to maybe new product introducer in the market. So, we have to be very careful, because we have to give the reason to the people to shift to your product, your service, or maybe to choose your product or the service if it is new in the market, and to go for it, buy for it, and pay for it, and maybe accept the product in the market. And on the same basis, the future volume of demand may be estimated on the basis of the price elasticity, right? How much price is going to go up and down? That is the price elasticity of the demand, and what impact is going to have. Price elasticity coefficient is a very important component here. Price elasticity component and expected price change. So, you have to be very careful that 1 unit change in the price, 1 rupee change in the price is going to have how much change on the demand. If you increase the price, how much demand is going to go down? If you decrease the price, how much demand going to go up? So, you have to see that what is the relationship between the price elasticity coefficient and the expected change in the demand in the market. And next thing is that the price elasticity coefficient may be useful or may also be used to study the impact of the variable pricing. This is a very important, another important component, that to study the impact of the variable pricing we can study the price elasticity coefficient. That if you keep the prices variable, changing, going up and down. So in that case, for example, if the price is fixed and you are not able to reduce the price because your input cost is very high, accordingly your price is also very high. So in that case you have to be very careful that to control the prices you have to control the cost and you have to keep it variable. That if you are able to control the price, you are able to keep the price variable. Maybe if it is demand is going down, right, you can reduce the price. If the demand is going to go up, so it means you can little bit increase the price also. So it means you have to finally, because we have to obtain the demand or estimates, so it means the impact of the variable prices that may be obtained in future on the economic viability of the product or the project, right. So for that purpose what we do a sensitivity analysis. We increase the price and then we see maybe on the data basis, we have not gone to the market. So we create different scenarios. We create a most likely scenario, we create a optimistic scenario, we create a pessimistic scenario, we create the multiple scenarios and we vary the price. We keep the price variable. We increase the price. We see that, for example, if the price goes up from the present price to maybe the next level of the price because of any reason, because the cost increases, what impact it will have on the demand. And if the input cost goes down and the total cost of the product goes down, price of the product goes down, then what impact on the demand it is going to have. So it has a reciprocal relationship. Higher the price, lower the demand, lower the price, higher the demand. So because price elasticity of the demand is going to have a big impact upon the overall demand of the product or the service, so we have to be very careful that understand this relationship, because it is a reciprocal relationship. So if you want to increase the demand for your product or service, you always keep the price low as possible. And finally, we can say that in using the price elasticity measure, however, the following considerations are important. Right, following considerations are important. First consideration is price elasticity coefficient is applicable only in the small variations. Little change in the price can only be measured with the help of the price elasticity of the demand. If there is going to be a sea change in the price, for example, you are selling the product for the 5 rupees today, but because of any reason it is going to become 10 rupees. So it is a big change of 100% in the price. There maybe the price elasticity may not give you the better results, or maybe may not reflect into the desired manner or to the desired extent. But if it is a minor change, small changes, 5 rupee to 6 rupee or 7 rupees or 5 rupees to 4 rupees or 3 rupees, then you can understand that if there is a minor change, small changes in the price, there can be impact in the demand. But for example, there is a big change in the price going to be, say you can say that the price is going to be from 5 to 10 rupees, demand, how much demand is going to be impacted, and that relationship cannot be called as the price elasticity relationship, because that is totally an extreme relationship. And if it is, for example, is going to be from 5 rupees to 2 rupees or 1 rupees of the price, in that case also does not mean that people will start buying huge amount of the product or the service, because in that case that variation becomes meaningless. So within a acceptable range the variation has to be, and if that variation is there, that can be defined with the help of the price elasticity coefficient, and there we can understand that if you make the minor changes in the price, small changes in the price, small variations in the price, certainly it is going to make the impact and it is going to help us to measure the impact on the demand. Next important consideration is the price elasticity measure is based on the assumption that the structure and behavior of the organization as well as the product or the service remains constant. There should not be any serious change. For example, if you add new features, completely new features in the product, and you increase the price like anything, so there is no point making a comparison, because the old product was entirely different, new product is entirely different. So certainly the old price is different, new price is different, so you cannot make a comparison. So largely the structure and the behavior of the product, service and the enterprise should not change maybe very significantly If it is within the acceptable range, only then the price elasticity can be taken care of or can be studied, or the effect of the price elasticity coefficient can be studied. So, not a big variation in the prices, one. Small variations, then the price elasticity is going to show the results. And second thing is, that is the structure and behavior of the product, service, or the organization who is generating that product, that service, or manufacturing that product. That should also not significantly change. If you change entirely the product, right. So, for example, you talk about that a manual car is going to be now converted into automatic car. So, manual car can be compared with the manual car of the better version, but you cannot compare the manual car with the automatic car, because two models are entirely different. Prices may be different, their efficiencies may be different, maybe the requirements may be different, the customer, maybe the demography may be different, everything may be different. So, there no comparison would be possible. Price elasticity of demand is not going to make an impact there, but yes, within the given range, small changes you are going to do in the prices, you can see the change in the demand. For that, you can create the multiple scenarios, you can do the sensitivity analysis, you can do the scenario analysis, and finally you can see that if you make the minor changes in the prices, maybe up or down, you can see the impact upon the demand. And since there is a reciprocal relationship between the demand and price, so certainly demand is going to increase if the prices come down to a certain extent, and demand is going to go down if the prices go up. If it is not a necessity of the life, if it is a comfort or a luxury, if it is a necessity, impact will also be there still, but not a big impact, because people require the product, and if you increase the price, little bit increase in the price, people will not start looking for the alternative, they will continue to consume the product, maybe the demand goes down, right. But in the necessities, for example, if the price goes down, there will not be a big change in the demand, because it is a necessity and people will be buying it even the price goes up or the price goes down. So, minor changes, but if there is a serious change in the price and if the product is a necessity, then people will start looking for the alternatives. People will start looking for the alternatives. So, be careful that price elasticity, as we saw in the previous lecture, discussed in the previous lecture also, mathematically we try to see the relationship between the price and demand. That relationship is very, very interesting relationship. Always be careful that whatever the new product or service you are going to come up with in the market, that is going to be within the reasonable price. Anything you see, the past story, you talk about the Nirma story, you talk about the Jio story, you talk about these multinationals entering India, their stories, any company story you talk about is everybody has focused upon the price, because India is a price sensitive economy, or any emerging economy is a price sensitive economy, and there, for example, if any product has to succeed, any entrepreneur has to succeed, any venture has to succeed, certainly the requirement is, the first and the foremost consideration is, you have to keep the price of the product at a very reasonable level, right, so that people can afford to pay that, they can demand for the product, and your product or the service becomes a success. So, in the same process, in the series of the market and demand analysis and discussing the different methods of market and demand analysis, we have few more methods also. I will not go in detail, but in nutshell, I will discuss some methods with you, and the next method is the end use method. Under this method, what we talk about is that this is more useful, this method, end use method, is more useful for which kind of the products? It is for the intermediate products, for the estimation of the demand of the intermediate products. For example, we are manufacturing some sub product for some industry. Say, for example, we are manufacturing some say rubber parts for cars to be used in the cars. We are manufacturing some screws which will be used for the cars. We are manufacturing this gaskets for the window pans, tightening of the window pans in the cars. So, we are manufacturing that small part. So, that is basically intermediate product. So, ancillary units who are manufacturing the intermediate products for the end use products, there this method is very, very useful. And for example, manufacturing one car, it requires so many inputs, right from the steel to the tires, which are the bigger units. You require the small nuts, bolts, you require the gaskets, you require the window pans, you require the rubber parts, you require so many other things also. So, smaller to bigger things. Till the time a car comes in the market, there are multiple products required to give a shape to the car, and these products are called as the intermediate products. Largely, they are the industrial products, and for forecasting of the demand of such products. If you want to manufacture some screws, some nuts, some bolts, some gaskets, some window pans, some maybe the rubber parts for manufacturing a car. So, you can use this method because the total requirement of the cars we are going to sell in one particular year or maybe number of years in the market, that is going to make a big difference, and on the basis of that end use product, these intermediate products are going to be, the demand for these products is going to be forecasted. So, in this case, what are the important steps which we are going to follow? Identify the possible uses of the product, where your product is going to be used, only for cars or for the other vehicles also, maybe for the two wheelers also, or for the say four wheelers also, bigger vehicles also, or only in the cars, only in the small four wheelers also, family cars or maybe other different kind of the cars. So, you look for that and identify the possible uses. Next thing is define the consumption coefficient of the product for the various uses. So, we will see the consumption coefficient, it is basically a multiplying factor that for one end use product how many your intermediate products are required. So, with the help of an example in the subsequent slide we will see that consumption coefficient process, and then project the output level of the consuming industries who are going to consume your products and what is their output level. So, of the consuming industries you have to predict the output level, drive the demand for the product. So, on the basis of these first three factors you drive the demand for the product which you are going to manufacture. So, we are taking the example here that a certain industrial chemical which is called as INDCAM, right, is used by four industries. A certain industrial chemical INDCAM is used by the four industries, these are the alpha, beta, gamma and kappa, right. So, these four industries, this is industrial chemical INDCAM is used by the four industries and it is a intermediate product. So, for say predicting the demand for this product, right, for predicting the demand for this product we are going to take the help or with the help of an example of the end use products, we are going to identify that how the demand for the intermediate products can be projected. So, the consumption coefficient for these industries, right, the consumption coefficient for these industries, the projected output level for these industries for the year X and the projected demand of the INDCAM are shown in the table given below. So, it means consumption coefficient for the alpha is 2, consumption coefficient is for the beta is 1.2, kappa is 0.8 and gamma is 0.5, right. Projected output in the year X, right, of these products is going to be how much? So, we are going to manufacture 10,000 units of alpha, 15,000 units of beta, 20,000 units of kappa and we are going to use this 30,000 units of gamma. So, total number of units we are going to have of these four end products, right, alpha, beta, kappa and gamma, four end products we are going to manufacture in different units 10, 15, 20 and 30,000 units, and the multiplication factor which we call as the consumption coefficient is 2 for the alpha, 1.2 for beta, kappa is 0.8 and 0.5 for the gamma. So, you can understand that for alpha, product alpha in the year X, how many INDCAMs we require? Projected demand for INDCAM in the year X, we require the 20,000 units of the INDCAM for product alpha because total end product we are going to manufacture is the 10,000 units. Multiplication factor which we call it as the consumption coefficient is 2. So, it means 20,000 units of the INDCAM are required for alpha. Similarly, 18,000 units of INDCAM is required for beta depending upon this end product and the this consumption coefficient, right. And similarly, when you talk about is this part, so it means this is going to be 16,000 units of the INDCAM is required for this kappa, and for gamma we are requiring the 15,000 units. So, it means in this case total amount of the units, total number of units to be manufactured or demand for the intermediate product that is called as INDCAM in the year X is 69,000 units, right, 69,000 units. And basically this INDCAM is going to be, you can take any units, right, we are taking here as kgs. So, 69,000 kgs of the INDCAM is required to be produced depending upon the requirement of the end products which we are going to manufacture, and there this product is required and the consumption coefficient is given to us here. So, on the basis of that, we are going to find out that this is going to be the end use, right. This is going to be the end use and this is going to be the intermediate products. So, 69,000 units of the intermediate product of this chemical, or you call it as Inchem or anything, it is a chemical or it is anything, it is a intermediate product. So, it can be manufactured because it is required in this proportion and for this much number of the end use or the end units which we are going to produce alpha, beta, kappa and gamma, and this is the total requirement which is to be multiplied on the basis of the number of units of these 4 products we are going to manufacture and the consumption coefficient of the respective products. So, we have to be very careful because this demand keep on changing. Maybe sometime consumption coefficient also changes, right, and demand in the industry also changes. So, we have to be very careful. This is a point of caution that end use method should be used judiciously. Sometime there may not be possibility that you are going to have 2 times or 1.2 or maybe 0.8, 0.5. There can be change in the consumption coefficient also depending upon the efficiency of the product, both intermediate product also and the end product also. So, we have to be very careful that it should be blindly followed, but broadly it is explained here that if you have some end product in your mind for which you are going to manufacture the intermediate products, and if you know the consumption coefficient, if you are able to find out maybe from any records or any data or any survey, then you will be able to use this method judiciously that I am manufacturing this intermediate products for the cars, total number of cars, maybe the company to whom I am a supplier, maybe Suzuki Motors, Hyundai Motors or maybe any other company, Honda or maybe Toyota, I am the supplier to, or if I am the supplier to 2 companies. So, how many total cars, different variants they are going to manufacture in the year to come, and what is the consumption coefficient for those cars as far as my product is concerned. So, you can easily find out the demand for your intermediate products. So, largely for predicting the demand of the intermediate products, we can use the end use method, which is a very interesting method. Next method is the lead indicator method. Lead indicator method is basically there are the 2 kind of the variables. One is the leading variable, right, this is called as a leading variable or the leading indicator, and second one is the lagging variable. So, demand of the one depends upon the demand of the other, right, demand of the one depends upon the demand of the others. So, you see here what is written here, leading indicators are variables which change ahead of the other variables because they are leading indicators. So, leading indicators are the variables which change ahead of the other variables, and those other variables are called as the lagging variables, right. So, in this case the moment the lead indicator takes, right, the speed or the movement the lead indicator takes, same way we have to study that the lagging say this variable will also be changing, and if we are going to manufacture the lagging variable, the product which is called as a lagging variable. So, we can easily understand that if we are able to measure the speed of the change of the leading variable or the leading indicator, accordingly we can say that because of the change in the lead indicator, the lagging variable, the product which we are going to manufacture is going to change like this. So, we can estimate the demand. So, for example, the change in the level of urbanization, the example given here, the change in the level of the urbanization which is a leading indicator, urbanization is a leading indicator, may be used to predict the change in the demand of air conditioners, which is a lagging variable. We are going to manufacture the air conditioners, right, and demand for the air conditioners may be affected by number of factors, but one factor can be that if more urbanization is there, more development is there, level of people, income of the people increases, right, they would start demanding for the more products which are not necessities or even comforts, but are luxuries, because air conditioner we can say in a country like India is a luxury. But when there is a change in one variable, for example urbanization, more people move towards the cities or more area comes under cities, more development takes place and more urbanization takes place. So, we can say, we can presume that level of income of the people is increasing, development level is increasing, urbanization is increasing, and as a result of that increased urbanization, development and increase in the income of the people, demand for the air conditioners will increase. Not in direct proportion, not in the same proportion, but there will be some connection. With that connection you have to establish by conducting some research. So, in this case, two basic steps are involved in using the leading indicator method, and these two steps are: first, identify the appropriate lead indicator, right. First, identify the appropriate lead indicator, which should be the most representative lead indicator. And second thing is, which is the most critical thing to be done, is establish a relationship between the leading indicator and the variable to be forecasted. Leading indicator and the lagging variable. So, this thing is very complex to establish the relationship between leading indicators and the variable to be forecasted. The principal merit of this method is that it does not require the forecast of the explanatory variables. No other variable is required. Simply we have to have the relationship between the one variable with the other variable. One variable is the leading variable, leading indicator you call it as, and the second one is the lagging variable, which is depending upon the leading indicator. So, no other explanatory variable is required, but in this case there are certain limitations which we have to be very careful, that number one, identifying the lead indicator is a challenge, and the biggest challenge in this process is that how to establish the lead and lag relationship. Here you require the people with the good knowledge of the econometric this analysis, and the person should have a very good background in the econometric analysis, so that he can understand that for one particular product, which we call it as the lagging variable, which should be the leading indicator or lead indicator, so that a proper, maybe a mathematical relationship can be established, and the demand for the lagging variable can be measured or can be set up on the basis of the leading indicator. So, challenges are there, and you can say that by using this method you will not be able to get the 100% correct demand, but you will be able to have the broader estimates, and those broader estimates may be very big help in establishing the demand or maybe forecasting the demand for the future, the product which we are going to manufacture. It may be air conditioner, it may be cars, it may be two-wheelers, it may be any other product which is linked to the urbanization, or it may be linked to the not urbanization, even to the income level of the people. So, income level of the people can easily be measured. We have the different kind of the sources, NSSO data is there, or maybe other ministries data is there. So many agencies are, CMI database is there. So many agencies are collecting the data on the income level of the people. So you can understand, when the income level of the people increases, they start demanding more such products which may be called as either comforts or luxuries. People will start demanding more two-wheelers or four-wheelers or air conditioners, CTVs, washing machines. So, if you are manufacturing any kind of the product like this, you can use the lead indicator method with caution. This is not the ultimate method, you have to use the multiple methods together, but one method can be which can give you the broader estimates, and there you can use the leading indicator method, and you can understand that yes, the demand for the lagging variable, the product which we are going to manufacture, the service which we are going to generate, can be determined on the basis of the leading indicator method, which is a very interesting and useful method of say predicting the demand for the products. And last in the row are the econometric methods. They are little complex, but they are very useful methods, and very precise and accurate estimates can be had by using the econometric methods, right. So you can use them also if you have that kind of the expertise, or you can refer your case to some consultants who have some that kind of the background. So they are largely based upon the primary data, right. Econometric methods are largely based upon the primary data. They are the mathematical models, mathematical relationship are going to be established between the one or the multiple variables. One can be dependent variable, other can be independent variables. There can be one dependent variable, multiple independent variables can be there. So econometric methods are the most scientific, accurate, and maybe the precise methods, but they are complex. We need to understand them properly. They need the appropriate data and the complete knowledge of these econometric methods and appropriate softwares to run these methods on, so that we can have the proper data, we can give the proper inputs, right inputs, and we can maybe clean the data, we can finally establish the proper relationship between the independent and the dependent variables, and finally we can draw the accurate results. So when you talk about the econometric methods, we have the two broad methods which we are going to discuss here, and they are called as the single equation model. First method is the single equation model. Which model is here? We have tried to develop this model here, right. So this model is having the multiple variables, but in the broader sense it has two variables. One variable is the dependent variable and other variables are the independent variables. So, dependent variable is called as the explained variable, right, and independent variables are called as the explanatory variables. So, one variable, you call it as a demand for any product or service, can be determined on the basis of the multiple explanatory or independent variables. So, demand of that product or service which we are going to predict is, that is called as the explained variable or the dependent variable, and the variables which are going to help us to determine that demand of that product or the service, they are called as the independent variables, which are called as the explanatory variables. Now, and there is a one way causality, right, there is a one way causality because one dependent variable and multiple independent variables. So, to understand this one way causality, what it postulates is that it has, for example, with the help of this equation you can understand, with the help of this model you can understand dt. dt is what? Demand for a certain product in the year t. Demand for a certain product in the year t, how it can be determined? It can be determined on the basis of these two independent variables. These two independent variables are what? One is the price for the product in the year t, and second one is the income in the year t, income of the people in the year t. So, demand of any product as per this single equation model, because only one equation we are able to find out or form out of this total given relationship. So, in this case demand for any product can be the output, can be the product of the two things, or can be influenced by the two things largely. That is the price of that product or the service, and second thing is the income of the people in that particular year. Now, it depends upon if it is a necessity, right. If it is a necessity, so the price will have and even the income will have a little impact, but if it is a comfort or it is a luxury, certainly the price and income will have a big impact. People will start demanding more comforts when the price is under control and income goes up. They will start more luxuries if the price is under control and the income goes up. So, it means it gives us an indication that you have, if you want to determine the demand of any product or the service, or if you want to increase the demand of any product or the service which you are going to manufacture or you are going to generate, always be careful that price is going to play a very important role. So, if you want to increase D, if you want to increase the demand for your product or service, always focus upon this P in the year T, that price of that product or service has to be within control. Income is not in your hands, income depends upon the number of factors, but because of any reason, if the income is going to increase and if you are able to control the price, these two independent variables are going to certainly have the very positive impact upon the dependent variable, and that dependent variable is basically the demand for the product which you are going to manufacture or the service you are going to generate. So, this we call it as a single equation model, first econometric model which can be used to determine the demand for any product or the service depending upon the number of factors. And we have then the simultaneous equation models, which is another econometric model. Number of econometric models can be, but we are going to explain you the simplest ones. So, simultaneous equation models are here, and in the simultaneous equation models, say it portrays the economic relationship in terms of the two or more equations, right. Simultaneous equations, because we are going to form the two or more equations in this case, and in this case we have a three equation model, right. We are going to, it is a very simple but a three equation econometric model of the Indian economy which we have tried to develop, and we are going to use, we are going to understand with the help of this particular model, the simultaneous equation model, we are going to understand that how the, say, the multiple equation model can be used for predicting the demand of any product. So, in this case, for example, when you talk about here is the GNP, gross national product of any economy, is the product of what? It depends upon what? It depends upon the government purchase, it depends upon the gross investments, and it depends upon the consumption. IT postulates the investment is a linear relationship of the GNP, and CT postulates that consumption is a linear relationship of the GNP, right. So, it means when the GNP increases, investment also increases and the consumption also increases, and vice versa is also true, that when the GNP increases, investment also increases, and when the investment increases, GNP also increases. When the consumption increases, GNP also increases, because people start demanding more goods and services. So, overall there is a boom in the market, boom in the industry, people start demanding more goods and services. So, ultimately we have to focus upon that if GNP of the country is going up, it means people are consuming more goods and services and people are making more investments. So, it means overall income level of the people has gone up. So, here in this case is the GNP means the gross national product for the year T, GT is the government purchase for the year T, and IT is the gross investment for the year T, and CT is the consumption for the year T. So, it means because gross national product is the function of three things. So, in this case this multiple equation model is, it means multiple factors are going to play a role on the GNP of the country, and when the GNP of the country increases, overall growth in the economy comes, and there is a possibility of manufacturing more products, generating more services and selling more variables in the market. So, we have to be very careful about using these models, because we need a proper data for that, proper input, proper data for that, and at the same time we need to understand what kind of the softwares we have to make use of it, how the relationship and interrelationship between and among us the variables have to be set up, and finally how to run the models. So, for 4 broader steps are involved. It specification means a mathematical relationship. Specification of what? That is a mathematical relationship between the different variables. For example, in this case we saw GNP is the product of the government purchase, gross investment and consumption. So, it means these 3 variables are going to impact and having a relationship with the GNP. Second thing is the estimation. So, you have to go for the proper estimation of the government purchase, gross investment and consumption. Verification of the data which we are collecting, if we are collecting ourselves, even in that case also, and if we are collecting through somebody, or maybe we are buying the data from some agency, we have to verify it. Once we have completed the first 3 steps, then the last one is the prediction, and prediction of the demand depending upon certain factors. So, we have to use these econometric models. These models are very useful. These are very powerful models, I would call it as. They are much better than the other models which we discussed so far in the market and demand analysis, because their merits are they are the mathematical models. They are based upon the data, and largely the data is the primary data. And when the relationship established is a mathematical relationship, that helps us to establish a logic. There is a logic in the relationship developed or maybe established amongst the variables. So, the outcome is going to be very accurate, precise and very helpful in predicting the demand for a product. But the limitations are also here, that number 1, you should be able to collect the right amount of the data from the right amount of the sources, establish a proper relationship and an interrelationship, run it on a proper softwares, and then make the proper predictions. So, if we are able to make use of the econometric models, maybe a single equation model or a simultaneous or the multi equation models, in that case I think these models are going to be maybe proved to be very effective model as compared to the non-mathematical models we saw so far. So, ultimately you are not going to make use of one method, you are going to make use of the multiple methods for assessing the demand for your product or the service which you are going to manufacture or you are going to generate for the society or for your market, and finally you are going to arrive at an estimate, and whatever the estimate we arrive at, we can refer that to the different consultants, and those consultants can verify that. We can take the expert helps, we can take the help of the consultants, we can take the help of number of other agencies who are expert in the market and demand analysis, and finally we can draw the relevant conclusions. So, these are some important methods we discussed so far. And finally, to improve the forecast of the market or maybe the demand analysis, we have to follow these steps. We have to check the assumptions which we are taking and on the basis of which we are going to predict the demand. Your assumptions have to be most realistic. Fundamentals have to be very clear. What you are going to manufacture, which market you are going to target, right, and how much demand you are expecting in the first year, who are your competitors, and maybe how you are going to take care of those competitors. Beware of the history. Last time what has happened in the market may not going to happen. For example, there were the 2 competitors. When third one came to the market, he got in the first year 5% market share, but does not mean that the 4th player in the market will also get the 5% market share out of the, say, the total market share in the market, and going to snatch some part of it from the existing players. May not be possible. watch out of the euphoria, don't be always a happy camper, always believe in the facts, fundamentals, right, and don't be dazzled by the technology. Technology is very useful, but it has number of limitations also, and technology is not going to do everything. So be careful. Improving the forecasting is depending upon number of factors, and last thing is just stay flexible. Any kind of changes, estimates, you need to make any kind of adjustment changes, you remain open to that and listen to the people at this level, so that finally whatever the demand you predict, that demand has a value and that's going to make a difference. There can be some uncertainties in the demand also, demand forecasting, especially because ultimately it is a forecasting. It is not the real demand, it is a forecasted demand. Real demand will come in the time when you will start manufacturing and delivering the product in the market. So at the moment it is only a forecasting. So there will be uncertainties, and if there is uncertainties, you have to accept there are going to be errors and uncertainties, and we have to check them. We have to use the three principles, from where these say uncertainties can arise. We have to follow these three say sources or the principal sources from where the uncertainties can arise in the market, and these principal sources are data about the past and the present market. That may not be going to stay as it is and cannot be as it is for the future. So you have to adjust that data. Past is not going to happen in the future, and even the present is not going to happen 100% in the future. Some changes, modifications and scope for the errors will be there, and you have to rectify that. Then you have to go for the methods of forecasting. The methods of forecasting you are using, how accurate they are, how logical they are, how correct they are, always take care of that. And environmental changes. There can be number of environmental changes, there can be technological changes, there can be changes in the liking and taste of the people, there can be changes in the any kind of the variables in the market. Always remain with those changes, environmental changes, and always keep track of those changes, so that you can minimize the errors, you can minimize the uncertainties. And while closing down the discussion on the market and demand analysis, so you have to cope up with the uncertainties, and here are some ways, some steps involved, that how to cope up with the uncertainties. So conduct analysis with the data based on the uniform and the standard definitions, right. So proper data analysis, number one is the data collection has to be very, very accurate, and after that you have to go for the analysis of the data, right. And then in identifying the trends, coefficients and relationships, ignore the abnormal or out of the ordinary observations, right, out of the ordinary observations. Always try to establish a relationship which is most logical, reasonable and acceptable, right. Critically evaluate the assumptions. When we are taking some assumptions, you critically evaluate those assumptions, so that the uncertainties can be minimized, scope for the errors can be minimized, and choose a method which is appropriate, most appropriate to the situation. Next thing is adjust the projections, right, derive from the quantitative analysis in the light of the unquantifiable but the significant influences. Some factors which cannot be quantified. You should not feel that my analysis is based upon the econometric methods or the mathematical analysis, so it is going to give me the 100% results. No, you have to, there is a scope for the adjustments. So you have to adjust that, you have to change that. All the times quantitative analysis is not 100% correct, or it is not foolproof. So you have to, there are certain factors which are unquantifiable, identify those factors, give scope to those factors, and their significant influence has to be measured. So we have to be very careful, don't maybe impressed with the quantitative analysis and feel that whatever this analysis gives me the demand, that is going to make a maybe difference and that is going to be 100% correct. And monitor the environment, that is again a very important thing. If you want to cope up with the uncertainties, then monitor the environment, because it is a dynamic, it keeps on changing. People's taste, liking, income level, everything keeps on changing with the time. So think of what people require today and what people require tomorrow. What changes in the product are required to be done with the passage of time, maybe in terms of quantity, quality, after sales service, packaging, anything you have to do, you should be open to that, and consider likely alternative scenarios and their impact on the market and competition. Today you are going to be the manufacturer, tomorrow somebody else can come and enter in the market. How that is going to impact you and your behavior and your existence in the market, always be careful about that. And lastly, conduct the sensitivity analysis. Conduct the sensitivity analysis so that we can change the multiple, maybe we can change one factor, that is a sensitivity analysis, or we can change the multiple factors, that is a scenario analysis. So, keep on changing the factors. If the price goes up, impact on the demand, price goes down, impact on the demand. If people's taste change, impact on the demand, new competition comes in the market, new products come in the market, alternatives come in the market, impact on the demand. So, everything we have to think about it, and we have to conduct the sensitivity analysis. We should go for the scenario analysis, but if the scenario analysis is not possible anyhow, go for the sensitivity analysis, conduct the proper sensitivity analysis, keep on changing the variables, see the impact on the demand, because for you the demand is important. For the entrepreneur, demand is important. He can only set up the venture if he is able to cope up with that demand, and he is able to generate that demand, cope up with that demand, and sustain with that demand in the market. So, these number of factors which we discussed till now in the past, many number of factors we talked about, we discussed in the past. So, those factors, those methods, those factors are important. Always use those methods, some of those methods, not one method only, multiple methods you have to use, and then you have to predict the demand. And finally, on the basis of this entire analysis, go for the last thing, and that last thing is the market planning. So, in the market planning you have the following thing to do. So, number one is current market situation, try to study it, what are the opportunities, go for it and make the proper analysis of the issues involved, what are your objectives, what you want to do in the market, and you want to manufacture and you want to deliver the product or service in the market. After that, if you feel that everything is appropriate, you are able to fulfill your objectives, form your strategies, and finally give action to your thoughts, right. You convert your thoughts into the action, start manufacturing the product or generating the service, and then jump into the market, give the shape to your product or the service, come out with that and start delivering it in the market, and then see what is the reaction. If you have done the proper market and demand analysis, if you have visualized everything what is going to happen in future, if you have used the proper market and demand analysis methods, there is no reason that you are not going to succeed. You are going to succeed, you are going to tap the demand, and you are going to generate the demand for your product. So, this all is about the market and demand analysis, and we have discussed in a very exhaustive manner, which is the most important thing I think for the success of any venture, any product, any startup or existing firm. Market and demand analysis is the most important thing. So, you have to go for it, make a proper analysis, take time, spend resources, and once you are sure that there is a demand for your product or the service which you are going to generate, only then you go ahead with that, and then you go make the proper you go with the proper analysis to the market. When you manufacture the product or you generate the service, with the proper analysis you jump to the market, you jump in the market, and if you jump in the market with the proper market and demand analysis, come out with the product or the service with the proper market and demand analysis, certainly you are going to succeed. So, with this all, we stop the discussion on the market and demand analysis. In the next class, we will be talking about the technical analysis for the new projects. Till then, please listen to this all analysis, this discussion on the market and demand analysis, and try to understand this is the most important facet of the overall project management. Till then, thank you very much.